Welcome to our comprehensive guide on hedge fund regulation. Hedge funds are unique investment vehicles that attract both institutional and individual investors seeking higher returns. However, with these opportunities come specific regulatory considerations that every investor should understand. In this video, we'll break down the essentials of hedge fund regulation, helping you navigate the complex landscape with confidence. Whether you're new to hedge funds or looking to deepen your knowledge, this series will provide valuable insights into the rules and protections that shape the industry. Let's start by understanding what hedge funds are and why regulation matters. Hedge fund is a pooled investment fund that employs various strategies to earn active returns for its investors. Unlike mutual funds, hedge funds often use leverage, derivatives, and alternative assets to maximize gains. They are typically open to accredited investors due to their higher risk profiles and complex strategies. Understanding the structure and objectives of hedge funds is crucial before diving into the regulatory environment. This foundation will help you appreciate why certain rules exist and how they protect both investors and the broader financial system. Regulation plays a vital role in maintaining the integrity of the hedge fund industry. Without oversight, investors could face significant risks, including fraud, mismanagement, or lack of transparency. Regulatory frameworks are designed to ensure that hedge funds operate fairly and disclose necessary information to investors. By understanding these rules, you can make more informed decisions and better protect your investment. In the next scenes, we'll explore the key regulatory bodies and the main laws governing hedge funds. The United States, hedge funds are primarily regulated by the Securities and Exchange Commission, SEC. The SEC oversees registration, reporting, and compliance for investment advisors managing hedge funds. Other important regulators include the Commodity Futures Trading Commission, CFTC, which supervises funds trading in derivatives, and the Financial Industry Regulatory Authority, FINRA, which monitors broker-dealer activity. Understanding the roles of these agencies helps investors know where to turn for information and protection. Investment Advisors Act of 1940 is a cornerstone of hedge fund regulation. This law requires most hedge fund managers to register with the SEC and adhere to strict reporting and disclosure standards. Registration ensures that advisors meet certain ethical and operational benchmarks, providing a layer of protection for investors. The Act also mandates regular filings and transparency regarding fund operations, fees, and conflicts of interest. These requirements help investors make informed choices and reduce the risk of fraud. Hedge funds are generally limited to accredited investors, individuals or entities that meet specific income or net worth thresholds. This standard is designed to ensure that only those with sufficient financial sophistication and resources can participate in these high-risk investments. The accredited investor rule helps protect less experienced investors from potential losses and ensures that participants understand the complexities involved. Knowing whether you qualify as an accredited investor is a key first step before considering hedge fund investments. Most hedge funds rely on private placement exemptions to avoid the full registration requirements that apply to public offerings. These exemptions, such as Regulation D, allow funds to raise capital from a limited number of qualified investors without registering each offering with the SEC. While this streamlines the fundraising process, it also places greater responsibility on investors to conduct due diligence. Understanding these exemptions helps you recognize the balance between regulatory oversight and investment flexibility. Transparency is a key principle in hedge fund regulation. Registered hedge fund advisors must provide detailed disclosures about their investment strategies, risks, fees, and any potential conflicts of interest. These disclosures are typically found in documents like the Form ADV, which is filed with the SEC and available to investors. Reviewing these documents carefully can help you assess whether a fund's approach aligns with your risk tolerance and investment goal. Hedge fund regulation includes robust anti-fraud provisions to protect investors. The SEC enforces rules that prohibit misleading statements, misappropriation of asset, and other deceptive practices. If a fund manager violates these rules, the SEC can impose fines, sanctions, or even bar individuals from the industry. These protections are essential for maintaining trust in the market and ensuring that investors have recourse if something goes wrong. Registered hedge fund advisors are required to maintain detailed records of their operations, transactions, and communications. These records must be available for SEC inspection and are crucial for regulatory oversight. Regular reporting helps ensure that funds are operating transparently and in compliance with the law. For investors, this means greater visibility into how their money is managed and reassurance that there are checks and balances in place. SEC's custody rule requires hedge fund advisors to safeguard client assets with qualified custodians, such as banks or broker-dealers. This rule is designed to prevent misappropriation and provide an additional layer of security for investors. Custodians must provide account statements directly to investors, ensuring independent verification of fund holdings. Understanding the custody rule helps you know how your assets are protected within a hedge fund structure. Hedge funds often use leverage to amplify returns, but this also increases risk. Regulators require funds to implement robust risk management systems and disclose their use of leverage to investors. These controls help prevent excessive risk-taking that could threaten both the fund and the broader financial system. As an investor, understanding a fund's approach to leverage and risk management is crucial for assessing its suitability for your portfolio. Many hedge funds use derivatives to hedge risk or enhance returns. The Commodity Futures Trading Commission, CFTC, oversees funds that trade in futures, options, and swaps. These instruments can be complex and carry significant risk, so regulatory oversight ensures that funds use them responsibly. Investors should review a fund's derivatives strategy and understand the associated risks before investing. Hedge funds must comply with anti-money laundering (AML) regulations to prevent illicit activities. This includes verifying investor identities, monitoring transactions, and reporting suspicious activities to authorities. AML compliance protects both the fund and its investors from legal and reputational risks. As an investor, you may be asked to provide documentation as part of the fund's due diligence process. Hedge fund marketing is subject to strict rules to prevent misleading claims. The SEC regulates how funds can advertise their performance, strategies, and track records. All marketing materials must be accurate, balanced, and not omit important information. These rules help ensure that investors receive truthful and complete information when evaluating potential investments. Proper valuation of fund assets is critical for fair investor treatment. Regulators require hedge funds to use consistent and transparent methods for valuing their holdings. This ensures that performance reporting and fee calculations are accurate. Investors should review a fund's valuation policies and understand how assets are priced, especially for illiquid or complex investments. Hedge funds typically charge both management and performance fees. Regulators require clear disclosure of all fees, including how and when they are calculated. Understanding the fee structure is essential for evaluating the true cost of investing and comparing different funds. Always review the fund's offering documents for detailed information on fees and expenses. Conflicts of interest can arise when fund managers have incentives that differ from those of investors. Regulators require full disclosure of any potential conflicts and steps taken to mitigate them. This transparency helps investors assess whether their interests are being properly safeguarded. Always pay attention to disclosures about related party transactions or compensation arrangements. Hedge funds often have specific rules regarding when and how investors can redeem their shares. These policies are designed to balance investor liquidity needs with the fund's operational stability. Regulatory guidelines require funds to clearly disclose redemption terms, including any lockup periods, notice requirements, and potential fees. Understanding these policies helps you plan your investment horizon and avoid surprises. Some hedge funds negotiate side letters with select investors, granting special terms such as reduced fees or enhanced liquidity. Regulators require disclosure of these arrangements to ensure fairness among all investors. If you're considering a hedge fund investment, ask whether any side letters exist and how they might affect your rights or returns. Manage liquidity during market stress. Hedge funds may include gate provisions or temporarily suspend redemptions. These measures are designed to protect the fund and its investors from forced asset sales. Regulatory guidelines require clear disclosure of such provisions, so investors understand the circumstances under which their money may be temporarily inaccessible. Registered hedge funds must undergo annual audits by independent public accountants. These audits verify the accuracy of financial statements and help ensure that funds are managed in accordance with stated policies. Audit results are typically shared with investors, providing an additional layer of transparency and accountability. Many hedge funds are domiciled offshore for tax or regulatory reasons. While these funds may not be subject to all U.S. regulations, they often must comply with local laws and may still be subject to SEC oversight if they accept U.S. investors. Understanding the regulatory environment of offshore funds is important for assessing risks and protections. Hedge fund investments can have complex tax implications, especially for U.S. taxpayers investing in offshore funds. It's important to understand how income, gains, and losses are reported and taxed. Consulting with a tax advisor can help you navigate these issues and avoid unexpected liabilities. Regulatory disclosures should include information on tax treatment and reporting obligations. Hedge fund regulation is constantly evolving in response to market developments and emerging risks. Recent trends include increased transparency, enhanced risk controls, and greater scrutiny of fund managers. Staying informed about regulatory changes helps investors anticipate how new rules might impact their investments and the industry as a whole. Conducting thorough due diligence is essential before investing in any hedge fund. This includes reviewing regulatory filings, understanding the fund's strategy, and assessing the manager's track record. Regulatory disclosures provide a starting point, but investors should also ask questions and seek independent verification where possible. Diligence helps you identify red flags and make more confident investment decisions. Hedge funds often engage third-party service providers, such as administrators, auditors, and custodians. These firms play a critical role in ensuring operational integrity and regulatory compliance. Investors should understand who the service providers are and what responsibilities they hold. Reliable service providers add an extra layer of oversight and protection for your investment. If you suspect fraud or misconduct in a hedge fund, it's important to know how to report it. The SEC provides channels for investors to submit tips and complaints. Prompt reporting helps regulators investigate and address potential issues, protecting both your interests and those of the broader market. Hedge funds operate in a global marketplace, and regulators often coordinate across borders to address risks and enforce standards. International cooperation helps ensure that funds cannot evade oversight by moving operations offshore. For investors, this means more consistent protections regardless of where a fund is domiciled. Navigating hedge fund regulation can seem daunting, but understanding the key rules and protections is essential for any investor. From SEC oversight to disclosure requirements and anti-fraud measures, these regulations are designed to create a safer and more transparent investment environment. By staying informed and conducting due diligence, you can confidently participate in the hedge fund market and make decisions that align with your financial goals. Thanks for joining us on this journey through hedge fund regulation.